Good morning, everyone, and okay. Good morning, everyone, and first of all, let me thank you, WIRC, Ketan Sayya sir, and Abhishek Damne from Pune for having invited me here to give the keynote. It's a great privilege to be back at the institute to talk about few themes. Finished my CA in 2005, but as you heard, sort of shifted to economics rather than staying within the CA field, so lost touch with ICAI to some extent, but it was so good to listen to Sayya sir, to know about the initiatives that WIRC is taking, and I think this sort of conference is a very good way to get back to ICAI, start engaging more, and so I'm really very, very thankful to WIRC for having invited me here. So with this, I know we are a bit delayed, so I'm not going to speak full time, maybe 30, 35 minutes. Also, a lot of interesting panel discussions to follow after this, so in which I think more CFO-specific discussions would happen anyways about technology, AI, treasury management in the world of Trump, when you don't know what's happening to your currencies next day. So really, those will be a little bit more CFO-specific sessions. What I've tried to do in my session here is try to talk a bit about macroeconomy, and maybe as a CFO or as a treasurer or as consultants, the type of risks we are facing, but coming from the macro perspective. So that's really what I'm trying to speak about. Not everything that I will speak may map into your daily tasks at hand in some sense, but I hope most of the things I talk will be useful in one way or another. So with this, I'll get going with the session. So this is the type of agenda I have today. Let's talk about Indian macroeconomy. I also want to talk about a couple of themes as to what constrains India's economy from growing at 8% really, and we have a 2047 target of becoming advanced nation. So what are critical elements to reach there? But in particular, what is the role of CFO in achieving that target? It's at a macro level, you can fix targets, but the targets are achieved only by sort of doing things at micro level, and CFO and CAs are a very integral part of that micro transformation that shows up in macro data after, say, 2 decades. So I'm going to talk a bit about that. And then because gold is in sort of gold and dollar and US is all that we are talking every day, because that's what's ruling the world right now, I would like to spend 5-10 minutes on talking about gold and dollar, and really if sell America movement has arrived and are people selling America in some sense. So that's sort of the agenda I have for today. Let's start with a little bit of India-specific things. It's always good to know where we are in some sense. I have few slides. I'll not talk everything on the slides, but just to anchor my talk. So this is Q2, June quarter, GDP numbers. We grew at 7.8% as a country. That was sort of aberration. We are not growing at that fast speed, okay? So Q2 was sort of aberration at 7.8%. For fiscal 25-26, we are expected to grow roughly 6.7%. If you take average of most of the forecasting agencies, for 26-27, the next fiscal, we are expected to grow by 6.5, 6.2, depending upon which agency you are looking the forecast at. Couple of reasons which are sort of going to or are factored in this bit of a slowdown from where we are coming from 8.5% a couple of years back to 6.5% going ahead. One is little bit of export uncertainty. Export is a small part. That is what some economists say in terms of how much it contributes to our GDP, but it of course has an ecosystem that feeds into spending, domestic spending, because of the people in the export sector spend in domestic economy and so on and so forth. So export slowdown hurts a bit. And second reason is a little bit of government spending that has been the anchor of our growth in last few years, especially after COVID. That will slow down a bit. And I talk about I'll talk about government's financial situation a bit. And so this is just a guiding sort of a, I'm of course happy to share the slides so you can go over this on your own speed, but roughly consumption is doing well, 7%, expected to take a bump after GST rate cuts have happened. You can see government spending has been growing at roughly 7%, 7.5%, which is likely to go down in H2. H2 means second half of fiscal, right? And gross fixed capital formation, that's roughly equivalent to CapEx. However, the CapEx numbers are very strong here, growing at 7 and 8%, 7.8%, but most of this CapEx is coming from government, not from private sector. So that is going to be one theme I will talk about, which sort of constrains India's growth potential in some sense. And so these are roughly the highlights. Some of these numbers just came in yesterday. Yeah, I talked about the first point. We are, as a country, going through a significantly important phase. India was always characterized as a high inflation economy, and that matters. If inflation is high, cost of borrowing is high. If inflation is high, not only cost of borrowing is high, but cost of borrowing is additionally higher because people not only want compensation for inflation, but they want compensation for the risk that inflation might actually overshoot your expectations. Turkey and some of the Latin American economies suffer from that problem. India used to suffer from that problem, but given where our inflation trajectory has settled over the last 3-4 years, I think we are getting out of that problem. So yesterday the numbers came in, our inflation is 0.25%, which is 0% really. And so from that perspective, we are as a country going through a very, very different macroeconomic phase, and that means that your input costs are subdued, competition is growing, so your margins can come as a company only through cost efficiency, other cost efficiencies rather than hiking up the prices, because your competitors are not hiking the prices, they're reducing the prices. So that also means something about where your margins are going to come from. As a country, we are sort of also improving on our unemployment scenarios. There are various numbers. I mean, you can look at ILO numbers and some other numbers, and these numbers can be a little bit bleak, but if you look at some of the mainstream data, I think our unemployment rate is roughly around 5.1%. It has come down from roughly 6% mid-year and so on and so forth. One of the numbers that economists track is how many people sort of applied for government schemes for the unemployment insurance, okay? That has fallen from 35 million in June to 12 million now. So that's like a 66% decline, which is kind of very significant. So India is going through, just to summarize, India is going through a reasonably moderate growth phase, low inflation, falling unemployment, creates a good foundation for the growth going forward. One thing that's been lacking is private capex. That's where I think the focus will be in next couple of years. So if you look at all the YouTube videos on ET conferences and summits and so on and so forth, people are talking about capex, and really the old type of capex, manufacturing capex, not AI type of capex. That's one thing that is sort of little bit lacking in Indian situation. How did Diwali go for business? Diwali went very well, 6 lakh crores of sales, very high sales. This is like 25% jump relative to 2024, so we did well. One of the numbers after GST rate cuts has been two-wheelers and four-wheeler sales. So two-wheeler sales jumped by 52% in October compared to last October. So that's a YOY growth. That's kind of mammoth. So if you look at Federation of Automotive, like auto dealers, they're calling this a historic month for Indian auto sector, which is roughly correct. So there are very good, I would say, very good numbers to sense that we are having a very strong foundation for the growth going ahead. I was just talking about low inflation. Low inflation is good for consumers. We pay less, or we are not at least paying 10% more next year compared to this year. But that also means a little bit different scenario for farmers. Think about farmers. We have 200 million farmers in our country. If inflation is low, the prices they are getting for their crops is also low, and so they are going to sort of receive, unless government supports through minimum support prices, farming income is going to be slightly on the lower side this year. So the only reason I have, and you can see the Bloomberg's estimate of how much sort of the income for the farming sector will grow. That is the last bar chart. Compared to 24, 25 fiscal, 25, 26 fiscal is going to have a subdued growth rate, the blue bar chart. And so I just presented this chart just to sort of have the idea that what's good for one section of the society may not be good for the other sections of the society. So government might need to step in to support a bit of the farming sector. Let me talk a bit about government finances, and then after doing this little bit of macro overview, then I'll move to a couple of themes which are more relevant for today's conference. How is government doing? So government is one of the biggest pillars of capex over the last 3-4 years. We have bumped up our capex through direct spending by government as well as through public sector entities, PSUs. And government spending sort of became one of the, I would say, important policy after COVID especially, okay. In H1, the first half of the year, government front-loaded the capex, and then we came with the GST rate cuts. GST rate cuts are likely to cut government's revenue by roughly 50,000 crores or 80,000 crores, anywhere between that. We will have to see how much actually consumption patterns change. That will determine how much actually consumption, like the tax collections would go down. But because of low inflation thing that I was talking about, low inflation also hurts government a bit. And the way it hurts government actually is taxes are collected on your profits or the actual amount of sales you are doing through GST. If the prices are low or prices are not growing, tax collections will also not grow. So nominal growth is sort of important from tax collection. Real growth is important from purchasing power parity perspective. But nominal growth is important from tax collection perspective. So you can see the corporate taxation and income tax collection both have sort of been very subdued this year because of low inflation. So government is on a path of undershooting its tax collections for this year, okay. Even after we successively increasing our tax net over last 5 years, I think this year government will have that problem with low inflation. Inflation projected was 5%, actual inflation is 0%. You are talking about 5% shortfall in tax collection straight away. And that puts our government in a bit of a fiscal situation. The debt to GDP for our government is 88%. That means how much debt government has relative to how much GDP we have. That's 88%, okay? That's roughly twice the average of other emerging markets. So we are, as a country, as a government, little bit on the higher side of debt. All the debt is domestic, that's fine. Most of the debt is domestic, not foreign. So we don't have a foreign currency problem, but we have a domestic debt problem compared to emerging markets. We have just received rating upgrade still because of macroeconomic situation, macroeconomic fundamentals being very strong. So roughly, we don't want to squander that away. So government is very mindful of that. Government doesn't want to borrow a lot. You see the last point on the slide. 42% of whatever debt government has issued, government issues debt through bonds, whatever bonds government has issued, 42% of those bonds have been picked up or bought by RBI. That's all. That's like a devolvement of an investment banker. That number was always in the range of 15 to 18%. That has shot up to 42%. So the private market demand for government bonds is sort of low at this point in time. So government, and we know that RBI is on a path of reducing the rates with 0% inflation. RBI is most likely to cut the rates again next meeting. So RBI has cut the rates by 100 basis points over last 6 months. But at the same time, government bond yields, the cost of borrowing for government has not gone down. So there is a bit of a fiscal situation that we are facing silently. We don't realize it, but we are facing it. And the moment government bonds are trading at 6.5% yield, as a corporate, your bonds cannot trade below that. So you are marked on top of government. So whatever spread you are paying. So till the time bond market sort of softens, whatever RBI is doing will not sort of translate into your cost of borrowing through bond markets, okay? And so it matters what happens to government from CFO perspective. So roughly that's where we are. Just a perspective, macroeconomist perspective on how you think about GST rate cuts, okay? It's largely a zero-sum game. Why I say it's a zero-sum game? You're not creating money, you're just transferring resources, you're just transferring money from government to consumers. Government could have collected that tax and government could have spent it on some of the government schemes without borrowing. Instead of that, government is giving consumers some disposable income which will show up in private consumption. The last sort of equation on this slide is again very illustrative. So consumer spending will go up, yes. But consumers, if they get 100 rupees, they don't spend 100 rupees, right? If government gets additional 100 rupees, government spends entire 100 rupees. Consumers, on the other hand, if they get 100 rupees, they are going to save, they are going to pay down their debt, something like that. So out of 100, roughly economists estimate that consumers will spend 60, but not 100. Government would have spent 100. So ironically, total consumption, by total consumption we mean government consumption plus private consumptions, is likely to dip after GST rate cuts. And that's counterintuitive. Not many people talk about it, but that's exactly what's going to happen, because in a counterfactual world, government would have spent more than what consumers will end up spending. And the government is losing 50,000 crores or 80,000 crores of revenues. They are not going to borrow additional money to sort of recoup those losses. So in some sense, the merit of GST rate cuts has to be understood not from the perspective of that, oh, total consumption will go up. It will not. Or the GDP rate will go up. No, GDP growth rate will not go up. What will happen is much needed relief for middle class consumer in the bottom of the pyramid, because the income growth in India is slightly subdued actually over last decade. So much of that support was needed. First tranche came through income tax cuts last year, and now through GST rate cuts. So that is needed. I'm not against this policy. I'm just saying you have to have different lens to evaluate the merit of this policy. It's not going to show up in total consumption. It's going to show up in consumers spending more and they getting relief and they lowering down their debt. And so banking health will improve because some consumers will have more money to repay their EMI, which they were defaulting on. So banking health will definitely improve. Okay, so that's roughly the way you want to understand GST rate cuts. Okay, a slide on Indian exports. If you look at the data, now tariff has taxed us 50%, 25% as a reciprocal tariff and 25% for Russian oil. We are very close to finalizing the deal. That's what we have been hearing for last number of months. So hopefully this time we are really close to finalizing the deal and some of this tariff sort of goes back, but it has hurt us. It has hurt us because if you see the first point, Indian exports to the US cumulatively has dropped by 34%. So if we were exporting 100, we are now exporting just 66. That has happened in just 2 months. This is roughly in line with what happened to China in 2018. Okay, in 2018, Trump put tariffs on Chinese goods. At that time, it was mostly a tariff war on China, and Chinese exports to the US for the affected commodities on which the tariffs were levied sort of went down by 30-40%. That's roughly what has happened to Indian exports too. So this is in line with what happened in 2018 in some sense. And so the only good thing is that with the deal nearing, some of this will sort of go back and we might recover our exports. What amount of exports are we talking about? Roughly, we export $85 to $90 billion to the US, but that also half of it is sort of exempt from tariffs of 45 billion. So we are talking about 45 billions of exports that are at risk. Okay, Gems and jewelry, for example, got hit to the US quite a bit, 68% drop of gems and jewelry. However, good thing is that some of these exports could be diversified away to Middle East, Latin American countries, Hong Kong, China, and so on and so forth. So roughly, we have been able to balance a little bit of exports to other countries. But if somebody tells you that, oh, doesn't matter, tariffs doesn't matter for export, they don't matter for export. That's not really true. It matters, and it has mattered in Indian case, okay? So again, just a point to note. Okay, so I'll skip some of these slides. Just the point that I was talking about, the white chart here is the yield on the government bonds for India, okay? And you can see that now RBI has reduced the repo rate by 100 basis points over last 6 months, but the government bond yields have not budged. They have in fact increased. So this chart goes from May of this year, and you can see from May, when the yields were roughly 6.25% on the government bonds, they have gone up to 6.5%, touched as high as 6.55% as the cost of borrowing for government on 10-year bond. Directly gets into your cost of borrowing, basically. So till the time government bonds are able to find buyers, the bond cost of, like the cost of borrowing in the bond markets is not going to soften. Okay. Now, having talked about this, let me just spend 5-7 minutes talking about the theme that is very dear to me. I've just picked up one theme because CFOs have a very important role to play in it. And roughly the theme is allocating capital very efficiently within your firms, okay? And you will see what I mean by that. Because of time, let me just roughly skip some of the slides, but this slide is sort of very important. It tells you what happened. So the point that I'm trying to make here is how India is expected to grow from here on, okay? How India is expected to grow from here on. But we, to compare the growth rates and numbers across countries, we have to use what is called as purchasing power parity, sort of dollars. Without going into much of details of that, in terms of per capita income in dollar terms, adjusted for purchasing power parity, we were in 2019, because that's the last data available, because it takes a long time to come up with these numbers. In 2019, we were at $6,500. China was at $15,000. USA was at $65,000, okay? So what I did is as follows. How countries have grown 30 years after they achieve where India is currently. That's it. So you pick countries exactly at a point in time where they were where we are right now. So pick a country when it was at $6,500 in their growth trajectory and see how that country has grown over last 30 years. Or after 30, like in 30 years after they crossed where India is currently. And you can see, you can just look at the first column really, mean. I don't want to go through all the columns, of course. So roughly you start from $6,800 to begin with, to begin your journey. And after 30 years, roughly you grow, if you had 100 rupees or $100 of income today, you roughly grow to $255. So that's a 2.5 times growth, cumulative. From 100, you are going to go to 255. That's average experience, okay? That's an average experience. So from 6,500, we would on an average path grow by 2.5. So that's roughly $18,000. That would put us slightly ahead of where China is currently after 30 years. After 30 years, so we are talking about 2050. If we have to follow the average path, okay? And so this is how it will look like, roughly. This is how India's growth path will look like on an average. Now you will say, oh, but India is not an average country, it's growing fast. But of course, some of these countries were also growing very fast when they were at India's scale, you know, like some of the Latin American countries were growing at 8%, 9%. China was growing at 8%, 9%. So some of these countries really were growing very fast when they were at our scale, but then the growth rate sort of slows down. Factoring all that, this is how India looks like after 30 years. So we start at 100 today, and we sort of, after 50 years, this chart sort of goes for 50 years. After 30 years, we would have gone to 269, so $20,000. And after 50 years, we would have grown by 4 times. That takes us to somewhere, after 50 years, it takes us somewhere where an average European country is, okay, like Estonia, for example. So path to becoming developed is not that easy. It takes 5 decades to reach an average European economy. Growth rate falters unless we do something about it. 6%, 7% growth rate drops eventually to 5%. China is growing at 4.8% this year, roughly plateauing from 8 and 9%. So as a CFO, we have a role to play, and I'll talk about it. So let's look at where the growth comes from. I know this is a little bit textbook, but we need to know some of these facts. So growth can come from 3 sources roughly. That's how the economists look at this. One, I'll go to table, growth comes from your manufacturing, your services, whatever you're doing, but from 3 factors of production. One, machinery, roughly your capital. Second, labor. We talk about we being young country, lot of labor force and so on and so forth. And third is technology. Technology sort of combines machines and labor and brings output together. Okay. So what this table does is puts US is in the first row. It puts everything for US as 1. So suppose US has 1 unit of something, how much other countries have in that type of or in particular dimension. Okay. So first column tells you if US GDP per worker, that's sort of the productivity, how much GDP, how much output you are able to produce per unit of labor that you are employing. Okay, that's your productivity in some sense. For US, if you put US at 1, India is roughly at 9% of that. So per worker, we are producing just 10% of what gets produced in US. That's where we are. This data is not too far. This is 10 years back. We have improved a bit, but not a lot. These are very slow moving variables, moves at a frequency of 50 years, for example. So we produce per worker only 10% of what per worker produces in the US. And why is that difference? Do we have less machines? And this is per worker. So we are talking about, so do we have less machines for a worker to work on? And you see the second column, which is capital. The capital, if US has 1 unit of capital, India has 80.82. So 82% of machinery that the US has. So we are comparable in terms of how much machines we are giving in some sense per worker. So the only reason why our productivity is sort of low is the way we are using technology and labor together to produce the output. And this is a very important growth accounting. This exercise is called as growth accounting, where the growth is coming from. And we talk in air sometimes, we have a lot of labor. Just putting labor on machines doesn't produce output. We are very inefficient in that. What we are lacking, so the remaining part is coming from technology. So a huge part of why India produces just 10% per worker compared to US is not because our machines are less or we have less capital in our country or less infra in our country, really. It's really about the technology. So that's where the growth really comes from. And some of the countries in this second column are kind of very interesting. Countries like Kenya and Malawi, which are you would think as low income countries, they also have roughly 80% of total machinery or total infra or whatever you want to call it relative to the US. So even some of the poor countries also have enough capital. It's just the way the capital and labor work together sort of decides where we are headed, whether we will grow at 8%, 9% or at 6% roughly. Okay, and so I don't have much time, but therefore I will not go in much of detail, but let me touch therefore on this theme quite easily. So what recent research is telling us is we don't need more capital, roughly. That's what our research is telling us. We don't need more capital. What we need is more efficient allocation of that capital. Means what? We want capital to be with companies or with units within your conglomerates or within your companies which are more efficient, which are profitable, which are more efficient, which are more productive. I will give you, and so Tangsha Shi and Peter Klino from Stanford and Chicago respectively, they did this exercise on India and China. And they said, do not invest even a dime in your economy. Okay? Just remove the capital from poorly performing, unproductive firms. And we have a problem of that. This is the data on how much unproductive firms we carry. So just to explain what this tells you, on x-axis you have productivity, okay? I will not go into details of that. You have productivity on x-axis, and what is the share of your firms with each level of productivity roughly. Look the graph for India relative to the US. As you go left, you are going into the region of low productivity firms. And you see India, the green chart or the green line, has such a high proportion because the height is very high. India has a large proportion of unproductive firms relative to China, relative to the US. So somehow we are not able to kill our bad firms and move the capital, banking capital, which is stuck in those bad firms, into good firms. And so some of the initiatives on entrepreneurship are very good, but entrepreneurs are struggling in some sense, even after having so many initiatives to find capital. Because a lot of banking capital, for example, is stuck in bad firms, okay? So just a simple exercise of moving capital from bad firms to good firms. By moving, I mean what? By moving, we mean liquidate the bad firms. We have instituted bankruptcy codes from 2016, which is hopefully going to improve our process of liquidation. And why liquidation is important, I mean, we prepare as chartered accountants, we prepare financial statements on going concern basis. So why I'm talking about killing the firms. That's exactly why the Nobel Prize of 2025 was awarded for creative destruction. You want to destroy bad firms so that good firms get the capital that's needed, okay? That's not only, and so if you were to just make your bad firms go away and move that much of banking capital and give that much financial capital to your good firms, your GDP per capita will grow by 50%. This number is not coming from air. This has been supported by a lot of detailed calculation. This is one of the top cited paper in recent times. Your GDP per capita can go up by 50% from $6,000, $7,000 right to $11,000. Just like that, if you were able to sort of let your bad firms die and good firms take off. Look at this. This chart is again very telling. This tells you the exit rates of the companies. By exit rate, we means how many companies sort of die every year. India has one of the lowest exit rates in the country. Unless bad firms exit, good firms can't enter. This is called as entry-exit dynamics, okay? Till the time bad firms exit, good firms cannot enter your economy and your productivity will not grow. And India has one of the lowest exit rates. This is really the bottleneck, I would say, and it is coming from many sources. I have highlighted a couple of sources here why it is very difficult for bad firms to die in India, and it's very important for bad firms to die. By bad firms, we mean firms which are not able to repay their loans, which are not productive, which are not producing at a good scale. Inefficient liquidation process, we all know, we are practicing. It takes at least a decade for a good company to get out. The value of remaining assets is virtually zero by the time you are liquidated. Stringent labor laws, we all know about Nokia's case. It took them so many years to sort of close down the plant, and so firing employees is kind of very difficult. It's a politically very controversial issue, but somehow economists have been able to identify that unless you have ability to scale up and down, companies will never scale up. If you know as a company that, oh, I cannot scale down tomorrow because of the laws, you are very cautious scaling up also, because then those are fixed costs. And so stringent labor laws in India has been identified, unfortunately, has been identified as one of the reasons why countries are not, some of the companies are not growing as fast in India compared to other countries, okay? And so that's roughly where, and so where does CFO come into this? CFO comes within this framework because this is not only true at the macro level. I'll just cite one research which tells in a conglomerate, in a big group of companies where you have multiple divisions, one conglomerate has maybe oil division, FMCG division, and so on and so forth. So you're talking about a conglomerate. There is a concept called as internal capital markets. What does it mean? Internal capital markets means within company, within a conglomerate, capital moves around. So if a particular division is in a trouble, you move some, in your treasury, move some liquidity from one, say maybe from parent to subsidiary to help that subsidiary out. Noble idea, good idea. only if used effectively. What has happened actually in India, so there are economists who track intercompany loans, intercorporate, like within group loans. Unfortunately, group loans go to the divisions within the group which are loss-making. So there was a very nice research done by Radha Gopalan, Vikram Nanda and Amit Seru. They tracked this data quite detailed, in a detailed manner. Loans, and so what they found, 3-4 findings which are very important. And that's where CFO has to put his foot down to say that, okay, we are allocating capital very badly. And we are constraining our conglomerate valuation. We are constraining our conglomerate growth because we are misallocating capital, okay? And this is a broad theme, but really important. And the point is as follows: loans goes up to the segments within a conglomerate reporting negative quarterly earnings. So the moment one of your subsidiaries report a negative quarterly earning, the probability that a parent gives loan to that subsidiary goes up in Indian data. So we are not using our parent liquidity to support productive subsidiaries. We are on an average as a country, okay? I'm not talking about a particular company. As a country, we are using parents' liquidity or group liquidity from treasury to support loss-making units. Loans go to segments. Again, this is a little bit controversial point. Loans go to the segments where insider shareholding is very high. So you have a group has maybe a family owner, and family owner has varying shareholdings percentage in subsidiaries. Loans are likely to be used from parent to those subsidiaries where insider shareholding is very high. Again, a evidence pointing towards that money is not going necessarily to support the division's productivity, but to support the valuations. No evidence of capex following the loans. If the loans are going to corporates, some of the subsidiaries, those subsidiaries should do something with it. That money should be put in capex, the working capital requirement goes down, something has to happen, or they repay debt. Nothing of that sort happens. Debt levels don't come down, capex doesn't go up. Then where the money is going? Because you are sort of inputting capital into loss-making units, that's exactly what's supposed to happen. And on average, the subsidiaries within conglomerates who receive these loans do not outperform other units or other conglomerates, other subsidiaries, okay. So in general, as a CFO, and I'm going to stop after this because I think I'm running out of time, roughly what's happening in India and where CFO has a very large role to play is the misallocation of capital theme, that bad companies are surviving and good companies are not getting enough capital, is not only true at macro level but also at micro level within companies. And as a CFO, we have to be very, very, very careful about where we are putting our dime, and that can improve not only the productivity for the conglomerate but also for the country at the end of it. There is a very interesting fact. Conglomerates trade at a valuation discount of roughly 15% in India. This exercise is very interesting. You have a big conglomerate of multiple divisions. That's the reason why Tata Motors also split. They say, okay, we want to split because we want to unlock the value. Really what it means is investors don't value you diversifying your portfolio. Investors can diversify their portfolio on their own. You can invest in all Nifty 50 companies quite easily. You don't want a conglomerate to do it. You don't want big conglomerates, you want clean businesses. That's what investors want these days. So if you put too many businesses together, investors don't appreciate. Actually, they discount you by 10-15% in terms of valuations. And one of the reasons why they discount you is because then comes as part of socialism that, okay, some of the CFOs are going to allocate or CEOs or the management is going to allocate capital to badly performing units at the expense of nicely performing units. There is this internal politics that takes place. That's sort of a important, empirically supported a channel. So, okay, do I have 2 minutes okay. I just want to touch base upon last particular because I took a little bit more time. Is de-dollarization happening at a speed that we think is happening? Roughly not. Dollar is everywhere. 85% of India's trade is dollarized. That means we invoice 85% of our imports and exports in dollars. 65% of cross-border loans are denominated in dollars, and so on and so forth. I can give you a lot of details. Even now, after so many central banks diversifying away from dollar to some extent, dollar still holds 56% of the share of the foreign exchange reserves for all the central banks in the world. And so if you look at where dollar is, it's at a very dominant position. Displacing dollar is, maybe some central banks are doing it, I'll show you, but not all are doing it. And it's sort of, we are far away from that stage. Okay, just to show you one graph, is that dollar has taken a tumble of 10% this year. So that people said, okay, dollar has gone down 10%, that means it's a sell America movement. Everybody is concerned about Trump, everybody is concerned about, oh, suddenly US has got a massive amount of debt, but US had massive amount of debt for last 15 years. So investors were not blind to that fact, right? Suddenly dollar is taking a tumble of 10% this year. Is it because of sell America? Data doesn't tell us so. What has happened actually is that interest rates in the US have come down. I'm just a data guy, okay? I just talk what data tells me. No narratives. Interest rates have gone down. One line is dollar, one line is interest rates. Dollar has slid down exactly in the proportion the interest rates have gone down. Exactly what economics model would tell you. And what this therefore chart tells you is two things. One, dollar has taken a dip because interest rates are lower, so that investors don't find dollar as attractive, because investments in US is yielding you low. So of course you don't want to invest so much in US, you want to shift your portfolio to maybe emerging markets. So of course dollar will not be net, the demand for dollar will go down, to that extent dollar will slip. And this looks exactly in alignment with how the interest rates have moved. But this tells me second thing. Interest rates are coming down in USA. If we were really troubled about US governments, we means as an investor body collectively in the world, if investor body in the world collectively is so much concerned about the fiscal situation of the US, the cost of borrowing for the US government should have gone up, not down. You should be lending to US government only very skeptically. And what we are seeing is that the US interest rates are coming down, not up. So that sort of tells me that it's not a sell America movement. Foreign ownership of the US treasuries has gone down only for central banks. If you look at the private sector, by private sector we mean mutual funds, hedge funds, other institutional investors, they have invested $420 billion in US treasuries this year alone, YTD, year to date. This number was like 20 days back, so it must have been $40 now, $40 billion. That's the entire size of gold ETF market as well. So the total size of gold ETF market is $420 billion. That much amount was incrementally invested in the US securities by private investors this year alone. So private investors are definitely not shunning away from US dollars, and neither all the central banks are shunning away from dollars. This is the chart that tells you which central banks bought dollar securities or dollar treasuries, means US government treasuries this year. Japan has bought 5% growth in their treasury portfolio. UK, China has reduced but only by 3%. Belgium, France, so most of the European economies are investing in US treasuries. India, China is diversifying, Russia is diversifying, but they are diversifying for the last 10-15 years. Not now. After Crimea, they're sort of doing this. So it's a broad-based trend. It's not that all central banks are diversifying. It's not that all investors are diversifying. Private investors are putting money in dollar. So it looks like that dollar is not getting displaced if you just look at the number. And therefore, now of course gold has rallied. This is my last slide. Gold has rallied by 50% this year. But is it because gold is really a safe asset? And I asked this question. I come from a gold finance company in some sense, Muthoot, FinCorp. Large portfolio is gold loans. And I asked this question in our H1 meeting that happened 2 weeks back. I said, what's the volatility of gold as an asset? So just to put ballpark number, Nifty 50's volatility risk is roughly last 10 years, Nifty 50's volatility is 14%, 15%. Over a longer horizon, it's 20%. S&P 500, which is a US stock market, broad index, the volatility of that index is roughly 16%. What do you think is the gold's volatility as asset class? 7-8%. Any other responses? Anybody who genuinely, I mean, now that I've asked, people will have various, genuinely if somebody feels that it's more risky than stock markets. Okay, good. Good. And it is more risky than stock market. Gold varies more. Gold's volatility is 17.5%. Gold is a risky asset class. It's not a good store of value in that sense. Because that means that your investments are at a risk of losing 17% in a year quite easily. I can give you some statistical bounds for that, but roughly that's the idea. So gold has not behaved very, you can see gold's volatility is 16.74%, 17% roughly. Silver is even riskier, 30% volatility, okay? Dollar on the other hand has a volatility of 8%, half of that. So assets are in general volatile. Gold is one of the riskiest of the assets in the world. And so institutional investors are not blind, they know this. JP Morgan knows this, Goldman knows this, everybody knows this. So they are going in gold not for store of value, they are going in gold for momentum reasons, okay, roughly. So that's where the institutional money is going. It's not a store of value type of a situation that they are trying to explore. Okay, so with that, just to wrap up, looks like that yes, a lot of money is getting invested into gold because gold is an under-invested asset, but it's not because people are moving away from dollars. Of course, there are some countries which are moving away from dollars strategically, India, China, Turkey, some of the Eastern European countries like former USSR countries and so on and so forth, but roughly that's what it is. With that, I'm going to stop with my keynote. I hope I touched upon some of the broad schemes. I know all of this may not be translatable in exactly action plan, but I hope I touched upon some of the things that were kind of interesting, and hope that you got some of our talking points. So thanks a lot, and again, thank you WIRC for inviting me. Thank you.